While you were watching the price charts, while you were celebrating silver breaking $84 and hitting $85, the real decision that changes everything was made behind closed doors in Basel, Switzerland. The Bank for International Settlements, BIS, the central bank of central banks, has officially passed the final implementation phase of the Basel III endgame rules. And this isn't a rumor. This isn't speculation. This is a regulatory mandate that goes into effect when markets open Monday, January 12, 2026. Today. Right now. They passed it quietly because they know it changes everything. This new rule forces banks to fundamentally revalue how they hold gold and silver on their balance sheets. For decades, 40 years, paper contracts were treated as good as physical gold. Starting today, Monday, that lie ends. The game has changed. And this is why silver exploded from $80 to $85 in hours, and why we could see $100 this week. Not next month, not next quarter, this week. My name is William Lee. I'm 33 years old, and I'm going to explain exactly why the banking system just forced the greatest precious metals explosion in modern history. Because last week I told you silver would break $84. It did. It hit $85. I told you Monday would gap up. It did. And now I'm telling you, we could see $100 this week. And the reason isn't just China's $47 trillion injection. It's not just Venezuela's collapse. It's not just Russia cutting supply. It's all of that, plus the fact that the banking system just abolished the paper manipulation that has suppressed silver for 40 years. To understand why this matters, why this is as significant as Nixon closing the gold window in 1971, you have to understand bank capital requirements. This is the plumbing of the financial system that nobody talks about, but it's what controls everything. And starting today, the plumbing just fundamentally changed. Before today, banks could hold unallocated gold and silver, paper promises, contracts that said they had metal but didn't actually have the metal, and count it as a safe asset on their balance sheet. They could short millions of ounces of silver on paper, and as long as they had a piece of paper saying they could deliver that silver someday, the regulators accepted it. This is how J.P. Morgan, HSBC, Citibank, Scotia held billions in short positions for decades without actually holding the physical metal. It was fractional reserve bullion banking, a pyramid scheme. The same bar of gold leased multiple times, the same ounce of silver claimed by multiple contracts. The Basel III endgame rule changes everything. It changes something called the net stable funding ratio, NSFR. This ratio determines how much capital a bank has to hold against different types of assets, and the new rule makes holding unallocated paper metal expensive and risky for the bank. It penalizes them for holding shorts. It makes fractional reserve bullion banking prohibitively costly. This forces banks to either buy physical metal to back their positions or exit the paper market entirely. They can't hold naked shorts anymore. They can't lease the same bar 10 times. They can't suppress the price with paper contracts that exceed physical supply by 100.1 or 250.1. Starting today, if a bank wants to hold silver as an asset, they need to actually hold silver. Physical, allocated, in the vault, audited. They passed this rule to prevent another 2008 crisis. The regulators looked at the derivatives pyramid, looked at the rehypothecation chains, looked at the leverage ratios and said, never again. We need banks holding real assets, not paper promises. But in doing so, in trying to make the banking system safer, they have lit the fuse for the greatest precious metals explosion in history. This rule is the death nail for the naked short selling that has suppressed silver for 40 years. J.P. Morgan and Citi can no longer hold billions in short positions without holding massive amounts of capital against them. The cost became too expensive. The cost of carrying a short position just skyrocketed by a factor of 10 or more depending on the leverage. It becomes economically unviable to manipulate the price. And we're already seeing it. We're already seeing banks unwinding their short positions in the overnight markets to comply with the Monday deadline. This is what happened Sunday night while you slept. This is part of why silver gapped from $80 to $84 to $85. It wasn't just China buying. It was also Western banks scrambling to cover shorts before the Basel III rules made holding those shorts illegal or prohibitively expensive. This buying pressure is what will drive the price to $100 this week. Not speculation, not momentum, regulatory compliance. Banks are being forced by law to buy physical metal or exit short positions, and there isn't enough physical metal available at current prices to satisfy this demand, so the price has to rise until supply meets demand, and that price is significantly higher than $85. We're talking $100 this week as the initial compliance rush happens, then $120, $150 as the full implications ripple through the system. But here's the most bullish part of this entire rule change: the reclassification of gold, and by proxy silver, as a Tier 1 asset. This is massive. Previously, gold was considered a risky asset like a stock. It was classified as a commodity, volatile, speculative. Banks were discouraged from holding too much of it because it didn't count as safe capital. Now, gold is considered risk-free capital just like cash or U.S. Treasury bonds. This is a fundamental philosophical shift. The regulators are admitting that gold, and by extension silver, is money. Real money. The kind of money that doesn't disappear when a government collapses or a currency hyperinflates. And this reclassification incentivizes banks to buy physical metal to strengthen their balance sheets. Think about what this means. For 40 years, banks were incentivized to suppress the price of gold and silver because higher prices hurt their short positions and made their paper assets look weak. Now banks are incentivized to accumulate gold and silver because holding physical metal makes their balance sheet stronger, safer, more compliant with regulations. They are moving from suppressing the price to hoarding the asset. When the banks switch from sellers to buyers, the price floor rises permanently. You don't get pullbacks to $60 or $70 anymore. You get a new structural floor at $85, then $100, then $120 because the banks aren't selling, they're buying, and they're required by law to keep buying until their capital ratios meet Basel III standards. This explains the liquidity vacuum we saw last week when trading halted briefly on multiple exchanges. The banks withdrew their sell orders because they knew this rule was coming. They didn't want to be caught short when the new regulations kicked in. The market didn't halt because of a glitch. It halted because the market makers, the banks, were stepping back to recalibrate their algorithms for the new Basel III reality. The game has changed from suppress the price to profit from shorts, to secure the asset to comply with regulations. And this changes everything, because when the banks that used to manipulate silver down are now forced to buy silver to survive, you get a short squeeze of historic proportions combined with a structural demand shift that lasts years. Industrial users like Tesla and Samsung are also aware of this rule change. They know that if banks stop selling paper silver and start buying physical silver, the available supply for industry shrinks dramatically. The price will rise to meet physical demand without the dilution of paper contracts. This is why we are seeing panic buying in the industrial sector. They are trying to lock in supplies before the banking sector sucks up all the available physical inventory to meet their new capital requirements. It is a race between the factories and the banks, and there isn't enough silver for both. Global production is 850 million ounces per year. Industrial demand is 550 million ounces. Investment demand has exploded to 400 million ounces as populations globally flee fiat currencies. That's already a deficit market. Now add banking sector demand. If major banks need to acquire even 100 million ounces to meet Basel III requirements, you're adding another 10–12% to global demand in a market that's already in deficit. The price has to rise until either demand is destroyed or new supply comes online, and new supply takes 7 to 10 years. So we're looking at years of structurally higher prices as this plays out. Here's where it gets even more interesting. China has been compliant with these rules for months. The Shanghai Gold Exchange operates on a fully allocated physical basis. Every contract is backed by physical metal in the vault. No fractional reserve, no paper dilution. The West is just catching up. This rule change is effectively an admission that the Chinese model, physical delivery, real assets, won over the Western model of paper contracts and leverage. By passing this rule, Western regulators are aligning with the East. They are admitting that paper derivatives are dangerous, and physical metal is the only true safety. This is a geopolitical shift disguised as banking regulation. The West is conceding that the Chinese were right about gold and silver. And when you concede that the East was right about the monetary system, you're conceding economic power. Why should you care? Because this rule makes the banking system safer in the long run, but it makes the currency weaker in the short term. To buy the gold and silver they need to meet these new requirements, banks will have to sell dollars and treasuries. This puts downward pressure on the dollar. As gold and silver revalue higher to meet the new Tier 1 standards, the purchasing power of the fiat currency holding them up must fall. The revaluation of gold is the devaluation of the dollar. This is a zero-sum game. If gold goes from being a risky commodity to being risk-free money in the eyes of banking regulators, then the things that were previously considered safe, dollars, bonds, are being downgraded by implication. Capital will rotate from bonds to metals, trillions of dollars will shift, and even a 1% rotation from the global bond market into silver would more than double the price overnight. If you hold an unallocated silver account at a bank, one of those accounts where the bank says you own silver but you don't actually have the physical metal in your possession, this rule is a danger to you. The bank is now incentivized to close your account or convert it to cash because holding your unallocated silver is now a liability for them under the new regulations. It counts against their capital ratios in a negative way. We expect to see banks sending letters to clients over the next few weeks saying, "We are discontinuing our precious metals program. Here's a check for the dollar value of your holdings. Thank you for your business." If you don't hold the physical metal in your possession, you're about to be cashed out at the worst possible time. You'll get a check for $85 per ounce while the market is heading to $100, then $120. And by the time you take that check and try to buy physical silver again, the premiums will be 30, 40 over spot and dealers will be sold out. You won't hear about NSFR or Basel III on the nightly news. It is too technical, too boring for mainstream media. They'll talk about market volatility and silver rally, but they won't tell you the root cause. The root cause is a fundamental change in how banks are allowed to leverage paper assets. The era of infinite leverage ended Sunday night when Basel III went live. This is as significant as Nixon closing the gold window in 1971. In 1971, we moved away from metal-backed money. The dollar became pure fiat, backed by nothing but confidence. And for 50 plus years, that system worked because everyone agreed to pretend that dollars were valuable. But the system is breaking. Inflation is out of control. Debt is unsustainable. Currencies are collapsing globally. And now, in 2026, with Basel III going live, we are moving back toward metal. It is a slow bureaucratic return to a gold standard disguised as banking regulation. The central bankers know the debt is unsustainable. They know the dollar is losing credibility. They know that at $36 trillion in debt, growing $1 trillion every 100 days, the math doesn't work. So they are preparing the lifeboats. And the lifeboats are made of gold and silver. With the banks stepping back from manipulation due to these new costs and requirements, true price discovery can finally happen. For 40 years, the paper price was suppressed by banks selling contracts they didn't have. Now that suppression is ending, we might see extreme volatility in the short term as the paper shorts cover their positions. But the long-term trend is set. The price must rise to a level where physical supply meets physical demand without the interference of paper dilution. That price is significantly higher than 85, based on the supply-demand fundamentals we've discussed. Industrial demand, investment demand, strategic demand, now banking sector demand, combined with the removal of paper suppression, fair value for silver is likely $150, $200 in the near term and potentially $300 plus over the next 12-24 months as the full implications play out. But there's another consequence of Basel III that nobody is talking about, credit contraction. Because banks have to hold more capital against their assets, they will lend less money to the general economy. This rule change will trigger a credit crunch. It will be harder to get a mortgage starting this week, harder to get a business loan, harder to get a car loan. The cost of borrowing is going to rise because banks have less capital available to lend. This deflationary pressure in the credit markets will be met with inflationary printing by the Federal Reserve. The Fed will see the credit crunch, see the economy slowing, and their response will be to print money and inject liquidity. This creates stagflation, a toxic combination of economic stagnation and high inflation. And in a stagflationary environment, precious metals are historically the best performing asset class. You get inflation eroding the value of cash and bonds. You get economic weakness crushing stocks. But gold and silver thrive because they're real assets with intrinsic value that benefit from currency debasement. The smart move is to align yourself with the banks. If the banks are being forced to hold physical metal by regulation, you should hold physical metal. If the banks are exiting paper contracts, you should exit paper contracts. Do not bet against the new rules. The Basel III document has been signed. The rules are active as of today, Monday, January 12th, 2026. The banks are scrambling to comply, the shorts are covering, the physical market is tightening. This is not a conspiracy theory. This is not speculation. This is a regulatory reset happening in real time. Let me give you specific details about how this works because the mechanics matter. For years, the London Bullion Market Association, LBMA, operated with a loophole that allowed unallocated gold to be counted as a high-quality liquid asset. This allowed banks to lease the same bar of gold multiple times through what's called rehypothecation. They could take one 400-ounce gold bar sitting in a vault in London, lease it to Bank A, who leases it to Bank B, who leases it to Bank C, and all three banks count that same bar on their balance sheet as an asset. This created a paper pyramid scheme where the claims on physical gold exceeded the physical gold by ratios of 100.1 or higher. Everyone knew it was happening. Everyone knew that if even 10% of claim holders demanded physical delivery simultaneously, the system would collapse. But the regulators allowed it because it kept gold and silver prices suppressed, which made fiat currencies look stronger by comparison. Basel III closes this loophole. It demands that for an asset to be classified as Tier 1 capital, the highest quality, safest capital, it must be allocated and physically present in the bank's possession. Not leased, not borrowed, not hypothecated, actually there. This forces the LBMA clearing banks to scramble for physical inventory. The days of fractional reserve bullion banking are ending, and when London demands physical delivery to meet these new ratios, the drain on global vaults will accelerate to a pace we have never seen. Every major bank in London, New York, Zurich will be competing to source physical metal, and there isn't enough available at current prices. The entire $100 trillion derivatives market rests on the stability of the banking system's collateral. By forcing banks to hold better collateral, gold, silver, actual assets instead of paper promises, Basel III makes trading derivatives more expensive. We expect to see a massive deleveraging event. Hedge funds that use cheap leverage to short silver will be forced to close their positions because the banks will no longer lend to them at low rates. The banks can't afford to lend to short sellers when the banks themselves need capital to meet Basel III requirements. This short covering rally will be driven by the mechanics of the banking system, not just market sentiment. It's structural, it's forced, and it's happening right now. Sovereign wealth funds in the Middle East and Asia have been preparing for this rule change for 2 years. They knew that once gold became a Tier 1 asset, its value would have to rise to support the global balance sheet. They have been front-running this regulation since 2024, accumulating physical metal quietly while Western investors were distracted by crypto and tech stocks. Now that the rule is live, we expect these sovereign funds to publicly announce new allocations to precious metals. When a fund with $1 trillion under management moves even 1% into silver, that's $10 billion of buying demand, hitting a market with only $72 billion of annual production at $85 per ounce. The market explodes, the price gaps, and retail investors get priced out, while Basel III focuses primarily on gold. Silver benefits by association. Historically, silver and gold move together. The correlation is extremely high. As gold reclaims its status as the ultimate money for central banks under this new regulatory framework, silver reclaims its status as the ultimate money for the people, the poor man's gold. The gold to silver ratio will contract. Right now it's sitting at 54:1. Historically, it's been 15.1. As investors realize that silver is the undervalued sibling of the new Tier 1 asset class, capital will flood from gold into silver for the leverage. If gold goes from $4,580 to $6,000, a 31% gain, silver could go from $85 to $200, a 135% gain, just by the ratio reverting to historical norms. We are witnessing the stealth remonetization of the entire precious metals complex. The regulators aren't announcing it, the media isn't covering it, but the rules have changed. Money is being redefined, and physical metal is being elevated to the highest tier of safety in the banking system. Ironically, these rules were designed to make banks safer in the long run, but in the short term, they make banks more vulnerable. Many banks do not have enough physical metal on hand to meet the requirements immediately. To get it, they have to buy it on the open market. But here's the problem. Many of these banks are also short silver. They've been suppressing the price for years, so now they have to go into the market and buy physical silver to meet regulatory requirements, which drives the price up against their own short positions. This creates a doom loop. Complying with the law means buying silver. Buying silver raises the price. The higher price increases losses on their short positions. The losses require more capital. They need more capital, so they have to buy more silver. The spiral accelerates. The Federal Reserve will likely have to print money to help banks buy the gold and silver they need to comply with Basel III. This is inflationary. It's money printing disguised as regulatory compliance. And it's another reason why holding physical metal is the right move. The Fed is going to print to help banks buy metal, which devalues the dollar, which makes your metal more valuable in dollar terms. There's an interesting conflict playing out between Basel III and central bank digital currencies, CBDCs. While one arm of the global elite is pushing for digital currencies and total financial surveillance, the banking regulators are pushing for physical collateral and hard assets. This suggests a split in the establishment. The commercial banks, JP Morgan, Citi, HSBC, want gold and silver to survive because their business model depends on trust and solvency. If they're insolvent, they die. The central banks, the Fed, ECB,